I have lived long enough to see one lesson repeat itself in more costumes than most people can count. The costume changes, the human response rarely does. A new headline appears, a war breaks out, oil jumps, television panels start shouting. Traders begin speaking with the urgency of surgeons in a hallway. Investors who felt calm 5 days earlier suddenly start acting as if the financial world has entered a permanently different era. Then I look under the hood and I usually find something more familiar than people want to admit. I do not say that to minimize the reality of conflict. Human suffering is real. Market screens do not capture it. But when I think about capital allocation, I have to separate moral shock from market mechanism. Those are not the same thing. And when they get mixed together, people start paying very expensive tuition. What catches my attention in an environment like this is not simply that the S&P 500 has rolled over from a consolidation range. It is not simply that oil has jumped or that fear has become fashionable again. It is that the market can be only a few percentage points from all-time highs and still feel as if panic has already entered the building. That is a very important distinction. A great many investors are trained to look only at the index level. They check one number, compare it to the high, and conclude that if the drawdown is modest, the damage must also be modest. That is a comforting simplification. It is also often wrong. You can have an index that looks relatively stable while the internal machinery of the market is grinding, rotating, liquidating, and repricing at an intense pace. You can have a broad average that is down only a little while fear, positioning, and leadership are all telling a much uglier story. You can have a market that does not look broken from far away, but feels broken to anyone close enough to see who is selling, what is getting bought, and how protection is being priced. That is the kind of tape I pay attention to when fear gets loud while the index still looks superficially composed. I start asking a different set of questions. I do not begin with whether the world is ending. I begin with where the pain is really coming from. I ask whether the war is the cause, the excuse, or simply the spark that landed on dry material. I ask whether we are watching a clean trend or a crowded mess. I ask whether people are reacting to price or to their own positioning. I ask whether this is a valuation problem, a leadership problem, an oil problem, a rate problem, or some combination that was already building long before the newest headline arrived. That is where money is usually made or protected. This particular setup interests me because it carries the outward appearance of a geopolitical panic, but the internal structure looks older than the latest conflict. Markets do not usually spend 5 or 6 months chopping sideways for no reason. They do not usually advance hard off a prior low, stretch valuations, exhaust a fashionable trade, wobble around interest rate expectations, and then suddenly become fragile only because one new headline arrived. Usually the headline gets the blame for a weakness that was already maturing in plain sight. I have seen that movie many times. By the time the public starts speaking about war as the entire explanation, the market has often already been telling a more nuanced story. Leadership has narrowed, previous winners have become heavy, positioning has become one-sided, valuations have outrun the ease with which a fresh buyer can justify paying up, the argument has become lazy. Then something dramatic happens in the world and people finally receive a narrative they can point to. The narrative is neat, the market is not. What I find more revealing is the evidence of internal stress. If asset managers are cutting exposure aggressively, if sentiment measures are reaching panic territory, if protection is getting expensive, if breath oscillators are deeply oversold, and if all of this is happening while the index is only modestly below its highs, then I do not see a calm market wounded by one event. I see a rolling correction. I see a market that has been digesting excess through rotation and churn rather than one grand collapse. That kind of correction confuses people because it does not feel fair. In a classic panic, everyone knows what is happening. Prices collapse, headlines match the chart, and the fear is visually obvious. In a rolling correction, the average investor keeps hearing that the index is not down very much, while his confidence keeps getting nicked. One group of stocks weakens, then another. Capital leaves one fashionable area and hides in another. A handful of defensive pockets start looking healthier than the leadership that got all the applause a few months earlier. Consumer staples and energy start attracting money while the old stars begin to sag. The index masks the damage. The experience becomes more disorienting because it does not come in one clean wave. That kind of environment is excellent at forcing people into bad timing. They sell quality too early because they are exhausted. They chase the areas that already ran because those are the only things still acting well. They confuse oversold conditions with safety. They confuse relative stability with absence of risk. They confuse a relief bounce with a durable turn. They confuse a headline about peace with the actual disappearance of the forces that caused the weakness in the first place. I have learned to treat those confusions as opportunities, but only after I decide what kind of participant I am. That is the next mistake I see. People talk about the market as if there is only one right response. There is not a trader and a long. Term investor may look at the same chart, the same war, the same oil spike, the same VIX reading, and reach opposite actions while both remain perfectly rational. The problem begins when someone with a trader's time horizon borrows the language of an investor, or when a long-term investor borrows the emotional tempo of a trader. That mismatch ruins more portfolios than most recessions. If I am thinking like a trader, I care about sequence, velocity, and whether a rally is merely a release of pressure or the beginning of a more durable advance. I care about whether fear has been overexpressed and whether the next move is reflexive. I care about unresolved risk, not just oversold readings. A trader can look at a market near the 200-day moving average and say, this is not a place for heroic certainty. This is a place for conditions. If volatility subsides, if oil eases, if the market gets a relief rally, there may be a tactical long if a rally appears without any genuine resolution and the underlying pressures remain in place. Then that same rally may become a place to hedge or reestablish downside exposure. That is a trading mindset. It has its place. It is conditional. It is not sentimental. If I am thinking like an investor, the question changes completely. I am no longer obsessed with whether next Wednesday is green or red. I care about whether fear is forcing me to look at quality assets at better prices than I had a week ago. I care about whether broad indices approaching the 200-day moving average are beginning to offer better dollar cost, averaging territory. I care about whether sectors and companies that were already beaten up before this latest panic are now offering asymmetry. I care about whether I am buying because I have a plan or because I have allowed a frightening screen to bully me into action. That is a very different exercise. Both mindsets can coexist. They just must not be confused. In a market like this, many people want one sentence that tells them what to do. That sentence does not exist. What exists is a decision tree. If the conflict resolves quickly, the market can rip. Markets often do that if energy pressure remains intense, if off-ramps fail, if volatility refuses to cool, if the fear of stagflation gets louder. Then a relief rally can fail and the correction can deepen. Both outcomes can occur over a short period depending on how the sequence unfolds. People hate that kind of answer because it demands attention and humility. I have found that reality does not care whether an answer is emotionally satisfying. The war itself also gets discussed with too much theatrical certainty. I have no interest in pretending that conflict does not matter. It does. Commodity shocks matter, oil matters, insurance risk around key shipping routes matters, the possibility of disrupted passage matters, but I have never liked lazy historical thinking. Markets do not automatically implode because the world becomes violent. History is full of wars, shocks, and geopolitical episodes through which markets eventually kept doing what markets do. Sometimes they dip hard first. Sometimes they scare everyone with a dramatic immediate move. Sometimes they recover faster than seems emotionally reasonable. People remember the fear. They forget the path after the fear. I keep that in mind when the conversation becomes absolute. If markets have often fallen in the immediate aftermath of conflict because of oil shocks and uncertainty, that still does not prove that every conflict ushers in a bear market. It proves that markets react to sudden repricing. That is not the same as saying they are structurally doomed. Most corrections are not bear markets. If a person begins with the assumption that every sharp bout of volatility is the start of a disaster, he can spend his life preparing for the exception while missing the rule. That is a costly way to live. What makes this episode especially tricky is that oil is not just a headline here. Oil is the bridge between geopolitics and monetary anxiety. When oil rises sharply, inflation fear returns immediately. Then people begin talking about the Federal Reserve. If inflation remains sticky enough, perhaps the Fed cannot cut. If growth slows while inflation pressure lingers, perhaps stagflation fears spread. Suddenly what looked like a war conversation becomes a rates conversation, then a valuation conversation, then a growth conversation. That cascade matters because markets are discounting machines. They do not wait for final confirmation. They begin repricing the path before the facts are fully settled. I have learned to pay special attention when the market starts doing that while everyone else is still arguing about the first headline. Suppose oil stays elevated for longer than investors had assumed. Suppose the market begins to believe that rate cuts will be fewer, later, or less useful. Suppose the relief many people expected from easier policy does not arrive on schedule. Now, the entire character of the tape changes. The old crowd that was leaning on lower rates to support stretched valuations starts losing one of its favorite pillars. The previous winners become heavier. Broad averages stop feeling effortless. Defensive positioning becomes more attractive. Money rotates. Sentiment sours. Protection costs rise. The market still may not collapse outright, but the easy part of the advance is over. That is not the end of opportunity. It is simply the end of laziness. Another point matters a great deal to me. Not every spike in fear deserves to be chased. When crude leaps, people suddenly feel compelled to buy whatever has already run. I have never liked chasing a move just because it is dramatic. If energy stocks benefit from higher prices, that is one thing. If a person buys the most obvious expression of panic after the panic is already obvious, that is another. The first can be rational. The second often amounts to donating money to someone who got there earlier. Good investing is not theater. It is arithmetic with temperament. The same applies to volatility. There are times when fear itself becomes tradable, but that is not the same as treating fear as a toy. A volatility spike that fails to grow can create one sort of opportunity. A volatility regime shift that keeps escalating can create another. Yet the person who believes every VIX spike must instantly reverse is just another man making himself available to the market for humiliation. Conditions matter, context matters. The line between temporary panic and deeper disorder is rarely visible to the person who wants a shortcut. That is why I return again and again to one practical principle. I separate what I know from what I am merely reacting to. I know when the market is oversold. I can see when sentiment is stretched. I can observe when asset managers are dumping exposure. I can note when broad indices are nearing important long-term moving averages. I can see when quality companies are already far from their highs and when certain sectors have been beaten up long before the latest scare. Those are observations. What I do not know is the exact timing of resolution. I do not know the precise path of diplomacy, retaliation, or de-escalation. I do not know whether a relief rally begins tomorrow morning or after one more flush. I do not know whether traders will first celebrate an off-ramp or first panic over the possibility that one never comes. The investor who pretends to know those things is usually advertising a temperament problem, not an informational advantage. Humility is underrated because it is not exciting television. So what do I do with all of this if I am managing capital? I begin by refusing to be hypnotized by the index level alone. If the market is only down a small amount from its highs, but the internals look washed out, I acknowledge that the emotional reality is more severe than the headline number. That helps me avoid one of the dumbest mistakes, which is dismissing risk, simply because the benchmark does not yet look catastrophic. Then I ask whether I am in a trading window or an investing window. For the trading part of my mind, I assume that short-term rallies can be violent in both directions because fear has become crowded. I assume that a relief bounce can occur around important support simply because too much pessimism has gathered too quickly. But I do not confuse that with a clean bill of health. If the underlying issues remain unresolved, if oil has not cooled, if volatility remains sticky, if the macro pressure still points towards stagflation anxiety, then I know a rally may simply be a better place to protect myself again. In other words, I do not grant a bounce the dignity of being called a new bull leg unless it earns it. That discipline saves a great deal of pain for the investing part of my mind. I become more constructive as prices get better, especially in places where the damage started before the panic headline gave everyone an excuse to sell. If high-quality companies are already down materially from their highs, if software or large-cap technology names have already gone through meaningful corrections, if broad indices are approaching long-term support that historically improve forward returns for patient capital, then I start thinking in layers. I do not need to nail the exact bottom. I need to improve my average opportunity set. That is what sensible dollar cost averaging is for. People sometimes mock that approach because it lacks drama. They want the one print where genius announces itself. I have never needed that kind of applause. If a quality asset is cheaper today than it was yesterday for reasons that do not impair its long-term earning power, my problem is not that I cannot buy the exact low. My problem is whether I have the emotional steadiness and liquidity to act when everyone around me is talking as if acting is madness. That is where real edge usually lives. I also keep reminding myself that broad corrections are not random personal attacks. They are a permanent feature of owning productive assets. People say they want the long-term returns of equities, then they meet the pathway by which those returns are delivered and act offended. But the pathway has always included drawdowns, fear, overreaction, sharp headlines, and moments when holding cash feels smarter than owning businesses. If a person is not psychologically built to endure that, then he does not actually want the return stream. He only wants the fantasy brochure. That realization clarifies everything. If the broad market approaches the 200-day moving average, that interests me. If it falls through and deepens toward a much larger correction, that interests me more, not less, provided the long-term thesis remains intact. A deeper discount on productive assets is not automatically a tragedy. It becomes a tragedy only for the person who needed the market to validate him every single week, or who committed capital without regard for liquidity, risk tolerance, or time horizon. I have never found wisdom in being forced to sell quality at distressed prices simply because I could not tolerate a temporary storm. This is where cash gets misunderstood. Cash is not a moral victory. It is optionality. But optionality only matters if it is eventually used. A person who hides in cash during every fearful episode and never converts that optionality into ownership of assets will slowly discover that safety can be erosive. Purchasing power declines. Inflation works quietly. Fear feels protective in the moment and expensive in the long run. The person who always waits for certainty ends up paying the highest price for it. I do not say that one should be reckless. I say the opposite. One should be structured. That is different. A structured investor can acknowledge the possibility of further downside without freezing. He can buy some now, reserve some for later, and welcome better prices if they arrive. He can distinguish between a tactical trader's hedge and a long-term investor's accumulation plan. He can recognize that a market may still go lower while also recognizing that waiting for emotional comfort is not an investment strategy. He can accept that good future returns are often purchased at the cost of present discomfort. That acceptance is a very powerful thing. There is another subtle danger in episodes like this. People start treating every relief rally as proof that the danger never mattered, or every renewed decline as proof that civilization is unraveling. Both are childish responses. Markets are not obligated to move in a way that confirms anyone's preferred narrative. A rally can be real for a while and still not durable. A decline can be serious and still not historically special. The wise participant learns to stay interested in process rather than addicted to one emotional verdict. That habit is worth more than any indicator. I am also drawn to the asymmetry between broad indices and already bruised quality names. If the market as a whole is still close to its highs, upside in the index may be limited relative to the risk of a deeper correction. But inside the market, there are often businesses already trading well below their peaks. Businesses whose future value was discounted heavily before the crowd fully noticed. In those cases, the next bout of panic can create a very different proposition. The crowd sees danger everywhere. The investor sees that some parts of the market have already absorbed a great deal of pain. That is where selectivity matters. I do not need every stock to be cheap. I need enough of the right ones to be cheap enough. The same logic applies to broad accumulation. If an investor has been waiting for a more attractive entry into index exposure, a fearful approach toward the 200-day moving average may offer a better starting point than the complacent conditions that existed when everything felt easy. Not because the 200-day average is magical, but because it often marks a shift in the emotional terms of trade. It forces people to think harder. It reminds them that prices can move both ways. It interrupts the mood in which buying feels effortless and replaces it with the mood in which buying requires intention. I prefer intention. Now, if the correction goes far deeper, toward a much larger drawdown, I become more aggressive not because I enjoy pain, but because arithmetic improves. The future expected return from a productive asset generally rises as the price paid falls, assuming the underlying business or index remains viable. That is not a slogan. It is the foundation of rational investing. People understand this perfectly when they shop for almost anything else in life. Then they forget it when a screen turns red. Fear is very good at making the obvious feel dangerous. The market also has a way of punishing both passivity and impulsiveness at the same time. The passive person, who refuses to think at all, never improves his behavior when better opportunities appear. The impulsive person overtrades every headline and exhausts himself into bad decisions. What works better is active calm, observe, prepare, scale. Hedge when the logic is there. Accumulate when the odds improve, keep some reserve. Do not pretend to know what cannot be known. Do not ignore what can plainly be observed. That combination has served me well. When I hear someone say this time is different, I usually ask in what sense different facts exist in every episode. The characters change, the slogans change, the technology changes, the headlines change, but human fear, forced liquidation, relief, regret, and eventual normalization do not change enough to justify surrendering every lesson from history. If I buy into the belief that every frightening correction represents a brand new rule book, I put myself at the mercy of novelty. I become easy prey. I would rather remain a student of behavior. Behavior tells me that crowded positioning matters. Behavior tells me that expensive protection can coexist with only modest index damage. Behavior tells me that overbought leadership can tire long before the public accepts it. Behavior tells me that the market often uses a headline as a trigger for a repricing that was already incubating. Behavior tells me that fear can be both justified and overshot. Behavior tells me that those who do not need immediate liquidity often benefit from those who do. That last point deserves emphasis in hard moments. The first seller is often not the one with the worst judgment. It is the one with the weakest position. He needs cash. He cannot withstand another week of uncertainty. He cannot tolerate another drawdown. He becomes a price taker. The buyer on the other side is not always smarter in some glamorous sense. He is simply better prepared. He has liquidity, patience, and a framework. Over time, that difference compounds into enormous outcomes. I have seen fortunes built less on brilliance than on readiness. So in this environment, I do not ask myself whether I can predict the next headline better than everyone else. I ask whether I can behave better than the average participant if the next headline produces another leg down, another relief bounce, or another round of confusion. Can I avoid chasing oil after the obvious move? Can I avoid treating volatility as a certainty machine? Can I recognize that a relief rally without real resolution may simply be another decision point? Can I add to broad exposure more constructively as fear rises? Can I focus on already beaten up quality instead of pretending the whole market offers equal value? Can I keep cash as optionality rather than as a permanent hiding place? Can I refuse to let a superficial index drawdown trick me into underestimating internal risk? Those are useful questions. I also remind myself that one does not get paid merely for having opinions. One gets paid for positioning capital in a way that survives reality. A perfect macro monologue attached to a fragile balance sheet is worthless. A dramatic warning paired with no plan is entertainment. What matters is structure. How much exposure do I really want if a relief rally fails? How much dry powder do I keep if a larger drawdown becomes available? How do I distinguish between a tactical hedge and a strategic purchase? Which assets have already endured enough pain that another wave of fear may actually improve my long-term odds? That is the work. I have never believed that the purpose of fear is to be eliminated. Fear is information. It tells me where stress is gathering. It tells me what others may do under pressure. It tells me where pricing may become irrational. But fear is a terrible master. The investor who lets it govern his actions will alternate between paralysis and regret. The investor who studies it calmly can use it as a map. That is what I try to do. The market right now appears to be giving both traders and investors a serious test. Traders are being asked whether they can distinguish a reflex rally from a durable shift. Investors are being asked whether they can distinguish a real correction from a story designed to make them abandon discipline. Both are being asked whether they can keep separate clocks in their heads. The one who cannot separate clocks will suffer. I prefer to keep my watch set clearly. If I were trading, I would stay conditional. I would respect the possibility of a relief move because fear looks real and internals look washed out. I would also respect the possibility that an unresolved geopolitical and oil backdrop could turn that rally into a better hedge point rather than a reason for celebration. I would not assume that one bounce cures everything. If I were investing, I would stay constructive as prices improve. I would think about layering into broad exposure as the market approaches zones that historically offered better long-term reward. I would pay close attention to quality companies and sectors already materially below their highs. I would welcome greater discounts if they arrive. I would remember that most corrections, however terrible they feel in the moment, do not abolish the long arc of productive assets. That is where my mind settles, not on prediction. on preparation, not on drama, on odds, not on whether fear is loud, but on whether fear is creating terms that favor patience. The market may yet give us more volatility. It may stage a sharp rally. It may sink farther into a formal correction. Oil may cool or stay troublesome. The headlines may grow quieter or more alarming. I do not need certainty before I can think clearly. I only need a framework strong enough to keep my behavior from becoming part of the panic that has always been the game. When the crowd sees only chaos, I try to separate layers. The surface layer is war, oil, the VIX. The moving averages, the breathless commentary. The deeper layer is positioning, valuation, rotation, exhaustion, liquidity, and time horizon. The deepest layer is temperament. That final layer decides who gets hurt, who gets shaken out, who buys too early, who buys too late, who never buys at all, and who quietly builds wealth while everyone else is narrating the storm. I have found that if I can stay loyal to that deeper layer, I rarely need to be the smartest man in the room. I only need to avoid becoming the most emotional one.